Hello, everybody. Hope you're having a good holiday season. Um, it's been a couple weeks since I've done a video, so figured I should get one posted. So today I just want to do a quick video and talk about some common rental investment or rental property expenses. Uh, just yeah, well, I always advise to a lot of clients that the best way to save on taxes is two real ways that we kind of try to save on taxes. And the first one's through understanding what correct business expenses are. A good term for that is permanent tax saving strategies. But basically, it's a better understanding. You set up your business and then you understand what are business expenses. That way, we're able to lower our taxes through proper education, I guess is a good way to put it. And then once your business grows and is making more money, you're going to end up owing taxes. Then the next best way to start lowering your business expenses, or I'm sorry, start lowering. We don't want to lower our business expenses. Start lowering our taxes is through real estate investments, and there's a couple of different ways you can get into real estate investments. Um, there's these things called Delaware statutory trusts, which I'll probably end up doing a video on those at some point in the future. Um, there's you just go out and you buy your own property. There's you can get into investment groups that specialize or buy real estate. Lots of different ways. Then the primary way that you're able to make money in real estate investing is actually on the tax saving side. And we do that through aggressive depreciation strategies, things called cost segregations. Is the primary way where you are able to take more than typical depreciation the first 5 years of the property. So then your depreciation significantly outweighs your revenue, creating tax losses. But you closed on your rental property and you're trying to determine, okay, I gotta get all my tax stuff together. What do I need to provide to my CPA? Now, I don't know how other CPAs do it or what they require for filing, but typically for us, if you even if you have your rental property in an LLC, we're going to file most rental properties as what's called a disregarded entity. Because of that, I don't personally require for my clients to have formal bookkeeping done. Uh, a disregarded entity, especially in rental investment property, doesn't rise specifically to the level of a full business. Therefore, it does for certain things in taxes. That's why I kind of said that in italics, I guess would be how I said it. In certain tax code situations, it does rise to the level of a business. But for like bookkeeping and reporting requirements, there's no difference between you and your investments in the eyes of the federal government. So therefore, we don't need to be, we're not treating it like a corporation. So I don't need formal bookkeeping. But that also means there's some things that aren't necessarily going to be allowed or they're going to be frowned upon more as an expense for a rental property than it would be in like a traditional corporation or an S corporation. Um, Now, if you're in a partnership, that's different. But typically, the typical person that's running a business, it's grown to the point where now they're starting to owe tax, quite a bit of tax on their business, so they go out and get the rental property. So, what are common expenses that we can see on there? So, the first ones you're going to have pretty much come off of the 1098. And, so if you have a loan, you're going to get a 1098. So the first expense is depreciation. That comes off of the purchase agreement. So that's calculated per tax regulation. So you don't even need to worry about depreciation. We will calculate that for you after we review your purchase agreement. Then the next common expenses that everyone should absolutely have on a rental property are unless you don't have a loan, you should have loan interest, property taxes, and insurance. I mean, those are kind of all required for any property you own. And there might be a few counties or jurisdictions out there that don't have property taxes, but I think pretty much everybody does. So any real estate you own is going to have basically four main expenses: depreciation, we calculate that, and then the 1098 gives us the interest, insurance, and uh, property taxes. Uh, that's pretty much going to be your expenses on any real estate. Now, the only way you're not going to have interest or is if you don't have a loan. And if you don't have a loan, that means your property taxes and insurance didn't get paid out of your escrow. So those are numbers you need to keep track of. But otherwise, your 1098 is probably going to give us the majority of your expenses. Now, when it comes to like there's always going to be a few other expenses. So anytime you repair anything on the property, if you hire contractors, basically anytime you spend actual cash to make that property usable, that would be a business expense. It's really hard to claim a home office, and you can't really have a home office deduction for investments. So that's going to be very, very difficult to claim because it's not a full business. It's investments. Now you can rise if you get a whole bunch of rental properties, you might be able to start playing with some of those rules, but for the most part, home office isn't going to count. When it comes to vehicles, the rule there is driving from your current home to the rental property and back. So you do have to keep a mileage log for that. Most of my clients, I say, hey, we're treating you on a corporation. Your corporation owns the vehicles. You know, that's really not going to matter. And then yeah, just basically you keep track of repairs and maintenance and cleaning and any utilities, so any cash you pay on it. So best way to put that all together is to, for us, give us the 1098, the original purchase agreement, when we'll have already had that hopefully, and then you really just an email of these are the other expenses we have, because normally rental properties aren't a lot of hassle when it comes to paying unless they're just sitting vacant. Now, short-term rentals are a little bit different, if it's an Airbnb or whatnot. That's going to have a few more things. And then if you're using a property management company, you're going to get a 1099 and you're going to have that management fee, which is usually somewhere between 2 to 5%, maybe 10%, just depends on your area. So that's really kind of it when it comes to rental property. There's usually your biggest thing is the depreciation, and then you're going to get some from interest and property taxes, and that's really the main one. So the 1098, 1099, if you get one from a property management company, handful of other expenses that were directly cash out to maintain or get it ready to operate or you make it usable, and then the depreciation. So I hope that helps clarify some questions. Let me know if you have anything in the comments. Thank you, and happy holidays.